In this video, we're going to have a look at the way that cash control is managed using working capital. So, an entity has many reasons as to why they may hold cash. Some of these reasons are as follows. So, a business is going to need cash in their account in order to be able to cover day-to-day expenses. For example, they're going to have to pay their suppliers. Not all suppliers are going to give on credit, and therefore it may be that the business has to pay cash up front. The business may need to cover any unexpected expenditure, so they are going to want to have cash in the bank to be able to do that. By the business also holding some cash, it allows them to be able to take advantage of any market investment opportunities that arise. This obviously would then lead to them potentially gaining a competitive advantage within the market. So if a business does not have cash, the following issues may occur. So they could lose suppliers' goodwill, which may mean that they aren't going to be able to have the same terms in terms of credit terms or the same sort of relationship with suppliers in the future. It could also mean that there is a greater potential for the company to actually go into liquidation. As I previously mentioned, industry relationships could become poor. Any settlement discounts may also be lost as a result of this. So, how can a business manage cash effectively then? Well, they can aim to collect debts as quickly as possible. So with this, it could be a case of offering lower credit terms. It might be that they pay their suppliers late. So they may use suppliers who give an extended credit period. And also, any cash that they do take should be banked promptly. So with this in mind then, a balancing approach is going to be needed, that of profitability and that of liquidity. So by profitability then, we need to minimise the holding of cash, which is an ideal asset, and invest more efficiently. On the opposite side of that, we have liquidity, which is the ability to pay bills as they fall due, and the fact that the entity should be able to take advantage of any opportunities at the time that they become available. What is a forecast then? So it can be referred to as a cash budget. It is essentially an estimate of any cash receipts and cash payments for a future period under any existing conditions. What are cash forecasts used for then? Well, if we think back to our statement of cash flow, we can sort of nail down on some of the comparisons directly here. So we are able to compare our budgeted figures to our actual figures. We can also plan for any cash shortages and surpluses. It allows us to assess and integrate operating budgets as well. So methods for creating a cash forecast then. So we can either use the receipts and payments forecast, or we can use that of the statement of financial position forecast. Either is fine, but it is up to the entity which model they decide to adopt. So the receipts and payments method then, the steps to preparing that we are going to have a look into now. And essentially all this is a forecast of cash receipts and payments based on the predictions of sales as well as cost of sales. Bear in mind that the timings of cash flows are going to be needed to produce a reasonable forecast. So the first step that is involved in this method is by preparing the pro forma. So there's no set way in order to lay this out, but it does have to include the following. There has to be a clear distinction between cash receipts and cash payments. It has to be arranged in a logical manner, and the figure for net cash flow for each period has to be stated clearly. The closing balance for each period of cash, as well as the opening cash balance for the next period, should also be clearly stated. So just to give you an example of what this may look like, this is a template that could be used by an entity when preparing one of these forecasts. Step 2 then requires you to fill in the simple figures. So some payments only need a small amount of work in order to identify the correct figure. The timing can be entered straight into the pro forma. And it's not limited to, but this pro forma may include wages and salaries, fixed overhead expenses, dividend payments, as well as the purchase and disposal of non-current assets. Step 3 then is looking at the more complex bit of this. So with this, it is going to be information on sales and purchases, because these can be more time consuming when we have to deal with this. So timings for both sales and purchases must be found from credit periods. The variable overheads may require information regarding the production overheads, and purchases may require calculations based on production schedules, as well as inventory balances. And that's the receipts and payments method. The next option that an entity may choose is to use the statement of financial position method. So with this, the forecast is going to be derived from predictions based on the future statement of financial position. These predictions will be made up of everything except cash in order to get to a balancing figure. So when using this method, the cash balances need to be predicted. For doing this, the method will typically consist of changes to retained profits, changes to share capital and other long-term sources of finance, future inventory levels, future receivables levels, future payables levels, and any changes to non-current assets, any acquisitions that may arise, and any disposals that a business may decide to use within that year. So an interpretation of a cash forecast then, there must be some things that are considered. So does the balance at the end of the period match with the expectations? Do any new sources of finance need to be sourced? And if so, how are we going to go about it? Are there any key causes of cash deficits? Is the cash balance overdrawn at any time? And are there any plans for dealing with cash surpluses? And finally, the last question that needs to be asked is, should any discretionary expenditure be made to stabilise the pattern of cash flow? So why are spreadsheets useful for cash forecasting then? So they are time-saving for preparing forecasts, and they are useful when completing the what-if analysis. Cash flow forecasts can also be consolidated with the use of a spreadsheet. So that's the basics then, but sometimes cash deficits will arise. But why? So it could be due to basic trading factors, increased costs, decreased sales. It could be due to short-term deficiencies in the working capital cycle, which could be as a result of a long average holding period for inventory, or it might even be a long average time to pay by credit customers. So if that short-term deficit does arise then, a business is going to have to make some decisions on how to deal with those. So how could they possibly correct this? Well, they may decide on taking out additional short-term borrowing. They may alternatively negotiate a higher overdraft limit with their bank. Or they may decide to sell some of their short-term investments if they have any. It could be through the use of forms of finance to reduce cash flows within the short-term period. It may even be a case that altering the discretionary cash flows by deferring expenditure or bringing forward revenues may work better in their favour. And that is basically the cash side of the working capital cycle.